Hi, this is Dustin with Dustin's Dollars. Today, NextDecade declared a positive FID on Rio Grande LNG Phase 1. And so I'm going to be discussing that today, talking about my updating my discounted cash flow model that I had presented in my prior video. It's been almost a month at this point. Updating that with the information that we got today and talking through a couple things here. So before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in NextDecade, so this video should be for your entertainment purposes only. Because I could be wrong about everything I say in this video, you need to do your own research before making any investment decisions. Okay, and I also figured, for the sake of time for folks, if you really just want to know what is the rough results of my DCF valuation, there's kind of two scenarios. Scenario one is if you are only looking at phase one and you want to give zero value to trains 4 and 5. If that's the case, the result of the DCF valuation, as far as I put in the assumptions, again, there's a range. I'm just giving you roughly the ballpark numbers here. And if you stick around, I will go through all the assumptions that go into it. But if you only look at phase one, which is trains 1 through 3, what they declare the positive FID on today, if you don't give them any credit for 4 and 5, I frankly think that NextDecade stock's intrinsic value is probably below its current trading value. I think its intrinsic value per the DCF calculation is probably somewhere around $6 per share. Again, not financial advice. That's just the result of the model. I can talk through what's in the model if you stick around for the video. However, if you include phase 4 and 5 at all, even with a pretty heavy discount rate, I think the stock is worth, I shouldn't say I think it's worth. The result of the DCF model put it well above $10, probably more in the $15 range, possibly up to $20, depending on how conservative or loose you are with your assumptions. So that's sort of the bottom line, and I'm going to walk through now a couple interesting tidbits about the deal, just give a quick overview, and then go into the actual DCF valuation model so you can understand where those numbers came from and how you might want to adjust things up or down based on what you believe. All right, so they declared the positive FID today, and they also, well, just as a semi-funny note, the stock ended up at the end of the day, after hours, up another 10 cents. We were down on the day, 7 cents, up another 10 cents after declaring the FID. So in the end, you could say maybe there weren't a whole lot of, it was what the market roughly expected. Again, I don't think you can really believe after hours pricing too much. We'll see what really happens tomorrow and over the next week or two to really know how the market digests this and what it thinks. So anyways, found a little funny. It did spike up, I think, up above $9 earlier in after hours trading, but that's not really, we'll see what happens. Just as a funny note. And I have my own thoughts, and maybe I'll go through that in a couple minutes as to why it didn't just moon. But, I could talk through that. All right. So they declared FID. Let's talk through a bit about what happened here. So if you've already been following along, this is the overall, picture here. They issued the notice to proceed to Bechtel. They need about $12 billion actually for Bechtel, for the EPC cost. They funded that mostly with debt, and then there's also a whole bunch of associated costs that brought the final price tag above $12 billion, and they funded that with equity. And they go through a little more details down here. So here's the table that shows the equity investments. Maybe I could zoom in. By the way, this is their corporate, updated presentation that's available on the NextDecade website. You can go find it yourself and take a look. So this is how much they sold to all of these other players, right? So to Global Infrastructure Partners, they sold 46.1% of Rio Grande LNG Phase 1. This is not 46.1% of NextDecade, the corporation. This is 46.1% of Rio Grande LNG Phase 1. And then you can see the percentages for some of these other folks. And in total, they sold 79.2%, meaning NextDecade retained ownership of 20.8%. And I think that honestly is, one of the biggest unknowns that I had. I think I stated in my prior video that going into today, we didn't know how much they are actually retaining from phase 1. Now we know. And there's obviously more information here, but that is a very, very key piece of information. Then they also outline here some of the options that these folks have in future trains, and trains 4 and trains 5, including some equity options for those, similar to the equity that they had in trains 1 through 3. So that's how the equity part came together. They also talked about the debt. There's not as many details here. It's really not that. I mean, the details do matter, but as of today, I haven't dug into this, so I wouldn't say I really appreciate the nuance here quite yet. But this on the right side gives you the highest level overview of all that funding, right? And the the uses of it, of the full $17.9 billion that it took to do this deal. Let's talk about the equity, the debt, and then some additional senior secured loans. And then the use of that, the EPC was the vast majority of the $12 billion, but then there's also financing costs, for $3 billion there, 3.1. And then, some owner's costs and some just other miscellaneous stuff, rounding error, not really rounding error, but $600 million is a huge amount of money. So couple other interesting tidbits as we do go through here. Yeah, this should already be known. They have their pipelines that are feeding it. They still didn't give, they say LNG customer specifics, but I'm not sure that there was any new information in this other than maybe explicitly specifying, in one concise place, which trains each customer is actually getting their LNG from. But there's nothing here that lets us ourselves really understand the details of how they're getting these profit numbers. And they have a projection further down, and that's what we're going to spend most of our time on. But this is one outstanding uncertainty. We still just don't know, what exactly did they negotiate with each of these individual folks. So that is it. Now they do highlight right here on this slide, and I'll talk about I'll just talk about it right now, is, how likely are trains 4 and 5 to happen? And they make the case here. They're basically saying, look, it's pretty likely. It's first of all going to be an expansion of the existing phase 1 facility, so that sort of puts it at a slightly lower cost. And there's already sales and purchase agreement options with Total for trains 4 and train 5. There's already been some discussions and alignment for their actual funding, the equity funding of trains 4 and 5. So like they say, partner options identify potential source of 60% of the equity financing required for trains 4 and 5. Then they also say, look, we can FID on trains 4 and 5 with less contracted equity. I don't know if they explain precisely why that is. Oh, it's based on internal observations and analysis of financial markets. But they say they really only need 80% sold rather than 92% for them to FID on trains 4 and 5. So they're saying, look, it's even more likely because we don't even need, we've already got 32% of that with the options that Total has. So if they execute those, then they've only got to close the gap between the remaining, 48%, to get to about 80% contracted. So, that's them making the case. And I personally, I believe it. I buy it that trains 4 and 5 are actually quite likely to happen. Obviously, if you're patient, it's not going to happen overnight. But I think I include it pretty heavily in my own valuation of NextDecade. Let's just put it that way. All right, so this is the most important slide if you really just want to understand the valuation. So they don't give a lot of detail, but they do give their projection of the distributable cash flow from trains 1 through 3, and then also from trains 4 through 5. And now, what does distributable cash flow mean? They do give an answer down here, and you may not be able to read it. I could try to zoom in, but I don't think it would work too well. I'll just read it to you real quick. Projected distributable cash flow is defined as the operating income of Rio Grande LNG less project level interest expense and debt amortization, and is presented based on NextDecade's expected economic interest in each train, less the estimated corporate, general, and administrative expense necessary to operate NextDecade Corporation and oversee its investment in Rio Grande LNG. Okay, and then they talk about how they, a couple additional nuances, how they estimate those quantities. But the point here is, this is, breaking that down, this is what NextDecade is receiving from these trains. This is after the project level interest expense, right? So we talked about there's all those senior secured loans. and that project, the construction term loans, the private placement notes, I believe, if I understand correctly, this is the project debt. This is all still at the Rio Grande LNG phase 1 level, all for that project, not necessarily at the NextDecade level. That's my understanding. I could be wrong, but that's the way that I'm reading this. And so they're saying, look, that's after they've already paid whatever the interest is they need to do on there. And this is after NextDecade's corporate expenses that are needed for Rio Grande LNG, right, to oversee the project. And this is, again, just the portion that goes to actual NextDecade. So that, 79.2% that is owned by other entities has already been taken out. So this is what you can expect NextDecade stock to have, sort of, again, as I say, distributable to it. So all of that being said, let's go ahead and go to the model. I guess there's one other note you would want to get out of this, and that's how many shares are actually going to be outstanding after FID, because there's some employee stock that vests. There is, you have the preferred stock that they've had outstanding forever is for a while. It's going to convert now into commons. And then Total, is buying stock, and so these are all these additional tranches of that. And I guess they have some warrants. I actually forgot about those, but they had some warrants outstanding. And so all of that gets you to, final count of 259 million shares. All right, so this gets us to the actual discounted cash flow model. And just as a quick refresher, what I did here was I projected out from 2023, and I actually extended this. I'm projecting out from 2023 all the way down to, 2048. So roughly, if you assume they start in about 2027, this is about 20 years of phase 1 cash flows and almost 20 years, 15 years or so of trains 4 and 5 cash flows. Now, to be fair, I actually just rounded it and assumed that the phase 1 cash flows would be the same all the way through the 20-year period, even though if you recall, some of their customers don't have 20-year contracts, they have 15-year contracts. But for today, I just assumed it stayed, presumably they'll find replacement customers, although they'll extend those contracts. So let's just look at this 20-year period here. And so I separately modeled the trains 1 through 3 cash flow, and then the trains 4 through 5 cash flow. And so the trains 4 through 5 start at a later year, and there's a different amount for trains 4 and 5. And then I have a discount rate that I apply to the net present value from each of those. And I use different discounted rates, right? Because I think there's different levels of uncertainty with, trains 1 through 3, considering they have a positive FID, and then trains 4 and 5 that are, a hope and a dream at this point, but certainly aren't as sure of a thing as trains 1 through 3 are, right? It could never happen. Then I also have a column here for corporate expenses. And now I made this one go away after phase 1 starts its operations. The reason for that was, they clarified here that their distributable cash flow in all of these years is after, the G&A expenses at the NextDecade corporation level that are necessary to oversee the investment in Rio Grande LNG. So I assume that's a good portion of their G&A, at least, if you exclude the carbon capture, wing of the company, that if that's still around, presumably will be generating its own cash flows and won't just be a drain. So that's this. As a side note, since I mentioned the carbon capture, I am not including that at all in this valuation, right? I'm just treating that as a zero. So if that also generates some cash flows for the company, that will be in addition to this valuation here. Okay, so with that being said, then I apply sort of I add all that up for each year. You get the net present value for that particular year, and then I just sum all of those up to get the present current day net present value. Hi, Wakaza, thanks for hopping on the stream. I know, just as a quick tangent for the folks interested in NextDecade, since Wakaza's here, I know you were interested in Nightscope. I do intend to have a near-term stream focus on Nightscope, but I'm not talking about that today. Maybe if I have time at the very, very end, we'll see if you have any, anything you want to bring up. But mostly, I want to dedicate a whole stream to that, multiple streams, because there's a couple things to talk about. But today's NextDecade. So, and yes, and I'll just say I'm sorry I haven't gotten to do too many streams recently. Life has been just busy. That's how it goes. Anyway, so back to this model here. The one other thing that added in is a terminal valuation at the very, very end of that term, in 2048 or 2049, some exit value for that. And then I backed it out all the way to today, given a discount rate being applied, over that long period of time. As of right now, and so the way I did that is just a multiple on the, a price free cash flow at that point in time, and then discounted back to today. I also have this for the number of shares outstanding post FID. And then I factored in how much cash they're actually getting from Total, because I think it's only fair to factor in that cash that they're receiving, given that they are, we are dividing amongst all the shares that are going to exist once they receive all that cash. And we are actually, subtracting off the corporate expenses in the meantime, where that cash, I assume, is going to be, applied towards, where it's going to be spent, at least in the near term. And the reason why this is $61 million rather than the full 219 million, whatever the amount was that they're getting from Total, is I didn't go over it before, but if you look at this project financing, somewhere up here, they state that NextDecade has a $283 million commitment. And then if you read this, the details say that's $125 million of pre-FID capital investments into phase one, which presumably they've already done. So I didn't worry about that. But then the remaining $158 million is going to be funded from the cash expected to be on hand from Total Energy stock purchase. So all that money that they're getting, they're putting some chunk of that right back into the Rio Grande phase one project. So net, if I calculated it correctly, they are receiving $61 million of additional cash, on top of that $158 million. So that's where that number comes from. All right, so hopefully that's enough, detail for you to understand how the model is working. Now let's talk about some of the assumptions that go into it and the final valuation here. So if I use a discount rate for trains 1 through 3, on that free cash flow of 12% annually, and I use their bottom number here. So let's go back to their distributable cash flow numbers. For trains 1 through 3, right, they're saying it's sort of backwards, but it's $200 million to $300 million per year on average over the 20-year period. And so let's use the bottom end of that range, say it's $200 million. We say that, trains 1 through 3 is going to start operations in 2027. And that's basically what we get for that. If we look at trains 4 through 5, they talk through $700 million to $1 billion per year in distributable cash flow, and that they don't have a current year where they project it to start. I put in 2030. I think that seems reasonable. You could reasonably say that it could start a little sooner or a little later, but I think that's probably that's what I've put in the model right now. I could change it if somebody really wanted me to, but that's where I've got it. So if we use the bottom end of their range, there's $700 million of distributable cash flow. Then and then we also apply a much higher discount rate. This is 20% discount rate. I think this is what I judge as roughly appropriate or even conservative. This I think is a pretty heavy discount rate, because you're saying, look, trains 4 and 5 are not, they don't have anywhere close to FID or even that much progress, right? They've got some options with Total for this stuff and options with equity partners, but they certainly don't have concrete binding agreements for any of this. So it's going to take time to get through that. It's going to depend on the market. So we'll see how things go. But if you want to include it in to your valuation, but still say, but that's risky, I'm using this higher discount rate of 20% for that. So using these assumptions, and then as of right now, this is sort of a conservative valuation. I wouldn't say conservative, but if I just say, as of right now, not even going to factor in the terminal value. So right now, I'm again, this is the value past the first 20 years of cash flows from the facility. If I just say at that point, it's worth $0, it's just going to go away, which is not really realistic. But as of right now, I have that in here just to kind of get a baseline. All of those assumptions put in, this gets me to a current per share, current equity value of roughly, $3.4 billion, which if you divide it across the current shares would be about $13 per share. And I think these are fairly reasonable, middle of the road assumptions. So, what could be even, let's go lower, right? Like things, there's still risks in here. This could be, this is not the most bearish possible valuation I could come with. So, and I guess maybe I could start with this. I said up front, at the very beginning, if you really think that trains 4 through 5 are not going to happen, you don't want to include that in evaluation, let's put that free cash flow at $0. So if we put that at $0, now all of a sudden, the valuation per share actually goes down quite a lot. There's actually, because of the way I set up the model, I have to change this discount rate here. Oh, no, I don't. Actually, I guess I must have changed it at some point. But if we do this, it gets down here. I think that's perhaps that's the most bearish way that you could model this, right? I think a fairly high discount rate of 12%, given that they have a positive FID, they use the very, very bottom of their estimate for annual free cash flow and assume no terminal value for Rio Grande for the facility. And that's, would get you to a fair value of $3.78 per this model. And that's obviously much below the current valuation. And so, as I say, I think that would be too bearish on a lot of these estimates. So if you start putting in things that I think are more reasonable, you say, well, let's give it a 10 price to free cash flow valuation at the very end. That doesn't really get you very much because I'm using a heavy discount rate. If I put that down to 12%, that gives you a little bit more for the terminal valuation, but not very much. Now, if you even just bump this up, again, this is only for trains 1 through 3, but you say, you know what, let's say they get the middle of the road in terms of their distributable cash flow, not 200, not 300, but right in the middle, 250. That's pretty significant. That gets us up to about $5.34 for a fair value. And I mean, personally, I think 12% is a bit high for the discount rate on those cash flows. Given the the level of risk, I think the level of risk is, in my opinion, for phase 1 for trains 1 through 3 is fairly low at this point. So if we adjusted that down just a little bit to a 10% discount rate, at that point, that's where I kind of said, you know what, maybe $6 is about fair value just for trains 1 through 3. Again, this does not include trains 4 through 5. This does not include the carbon capture portion of the business that might, produce its own set of cash flows in the future. So that is where I kind of got with that, let's say base case valuation of $6 just from trains 1 through 3. All right, so if we include in, so let's put back our 20% discount rate for trains 4 through 5. Let's also put in some free cash flow for that. So if you say let's say you were they're going to do trains 4 through 5, but they're not even going to hit their minimum, right? They're overestimating how well they can do here. They only said 2 to 3 for trains 1 through 3 and trains 4 through 5, which is less LNG export capacity. They think they're going to, more than double the distributable cash flow. Let's be skeptical here. Let's say maybe they only end up hitting $400 million from those. I think it's reasonable to expect that to be higher on a per million tons per year basis in terms of capacity. But maybe they won't be that high. So even if you go to that point, again, this 20% discount rate, let's say they don't even start that till 2032. Let's say it takes them a while. And then let's adjust this back down. Let's say, well, by the time this is done, nobody wants an LNG export facility. We've got solar everywhere, or whatever. Let's say it's not worth that much. Price it kind of like how coal companies are priced. Now you go very, very, 5 price free cash flow, which I think is fairly conservative. That puts you with all those fairly bearish assumptions at something closer to $11.33. Again, that is a good chunk higher than where it's trading at today, in the 8s. And this is what I think are fairly bearish assumptions. I guess if you want to be even more bearish, you could say their projection here might only be $200 million. Maybe they only hit the bottom of this range here for trains 1 through 3. And, if that's the case, okay, fine. Maybe you're more at $10, which is still a tad bit above the current trading price, but not hugely, right? That's what, a 15% upside or so, 10%, 15% probably. So that maybe, if those are sort of the assumptions you want to make and you want to put a kind of what I would say is a bottom line in terms of valuation, let's call it $10. Now, let's get slightly more optimistic. Let's say they hit the middle of their range for trains 1 through 3, $250 million per year in annual free cash flow. Let's say, let's go back for trains 4 through 5 and say that they even hit the minimum of their projected range there. They hit that $700 million per year. Let's say they do start this in 2030 as I think is realistic. And then let's say at the end, LNG is still, people still want an LNG facility. And so, if we want to value the facility at the end of this term, let's call it, at least an 8 price to free cash flow at the end. That's certainly not exorbitant, but it's not bottom of the barrel valuation. That puts us closer to, almost $18 current value per share. Now, and again, maybe you think 10% is too low for a discount rate. You want to make that 12%. That does eat into it a fair bit. That puts you down, just a tad below $15 per share. So, maybe those are some assumptions you want to make. Again, I personally think that 10% is, a discount rate on the lower side is more appropriate given the level of risk that we have, in the company. They made their positive FID. They've got Bechtel, that's going to be working on it. They're, have a great reputation. I think their contracts are fairly, low volatility. And so that I think is, in my estimation, is a reasonable discount rate to apply. So if you want to get bullish, right? Let's say even they hit the middle of their range for trains 4 through 5, and then let's start to say, you know what, I don't really need to discount it, at 20%, because I think it's fairly likely they've already got options with Total for selling a good chunk of trains 4 through 5. They've got, equity partners they've already worked with. The cost is going to be lower because they are these greenfield, or these brownfield trains rather than a brand new facility. Let's say it's 15% now, right? They haven't FID'd on it yet, and they've still got a lot of work to do. But let's say we still think 15%. It's a pretty steep discount rate to use even still. That puts the current fair value per this DCF model at $21, which is more than double. That's 2.5 times the current price. That's, again, I think if you want to start being pretty bullish, and if you want to be uber bullish, use the top ends of their ranges for free cash flow, keep the rest of the stuff here the same, and that's where you get even a current. So you can make this argument, right? I think this is net present value. You can make a case, if you want to be very, very optimistic with your assumptions, that the stock could be worth $25 today. I think that's a bit too aggressive. You're making a lot of things have to line up for this to be true, but it could be. We don't know. Well, Kaza says, wow, institutional ownership is at 68.2%. I guess they love this company. Yeah, and I don't know how that's calculated. I don't know if that would include in the, it kind of depends on the data source there. Part of that could include these the preferred stock. They've had a large portion of the company was issued as preferred stock that is now being converted into commons, like as of today when they declared the FID. But historically, they've had this preferred stock that's been held by institutions for years and years, and that's how they've kind of funded the company without diluting the common stockholders directly quite yet. Well, Kaza says, wrote a college paper back in 2017 on how we need alternatives in the energy sector. I'm favorable towards LNGs. Yeah, I am too. I mean, I think I did some videos. It's probably been a year at this point on kind of the role of LNG and the reason why I'm bullish on it. I mean, the reason why I'm bullish on it is because I think it fills a very, very good hole and niche in the transition. Where as of right now, I don't think there's enough solar, and some of these renewable sources to go around as at the economics that we would need it to kind of just replace all the energy usage. And I think natural gas doesn't have quite all the downsides of some other fuel sources, and natural gas is such a localized energy source that LNG is such a interesting and very useful way to kind of solve that. Especially even now, like where there's a big need, or at least a year ago there was a huge need. I think the need still exists. I think Europe kind of got lucky, but in Europe where there used to be the gas that was flowing through pipelines from Russia that is no longer flowing at the current moment. While Kaza says LNGs are a need, that's clear. Yeah, absolutely. And I think, yeah, you don't have to sell me on it. Sounds like I don't need to sell you on it either. Anyways, so that I guess was kind of what I all wanted to walk through. So, depending on the assumptions that you put in here, you could probably make a case, as long as you, if you don't include trains 4 through 5, as I said, it's probably more around $5-6. but including any sort of value from trains 4 through 5, you can make a case anywhere from $10 up to 25, I think, for a current valuation. I really think that personally, some of those assumptions that are middle of the road or more in the $15 range are probably pretty appropriate. I think 20 would be kind of the upper range where I personally would think has realized all of its current fair value, and would probably be looking to exit of some sort, take some off the table, at least. So that's kind of my current opinion and what I roughly plan to do. Not financial advice. You need to do your own research and make your own investment decisions. But that's kind of how I'm looking at it. So that is all I had for today. I'll stick around for just another minute. While Kaz, if you have anything you want to chat about, well, like I say, I do plan to have some streams in the near future focused on Nightscope. A lot has, I never got to talk about even their Q1 results, and then there's been some other things that have happened since then. Obviously the stock has gone, it's been very volatile recently, and that's something I want to discuss a little bit, but I don't want to focus on it too much today. But yeah, that's all I had for today for NextDecade, which was a lot. I know it was 30 minutes, so sorry everybody, but that's I wanted to explain everything that I had here, and so that you can kind of make up your own mind about what you think is reasonable, and what the impact is on the valuation there then. All right, I don't see anything else on the chat. Thank you, Wakaza, for joining in live. Really appreciate that. It's always nicer when I know that I'm not just talking to myself, and somebody else is here. But I think that's it for today. So I'm going to hop off. Thank you very much for watching, everyone, and have a good one.